All right. Occupancy has been a real issue in seniors housing the last year and a half. A lot of people are, trying to get their beds and units filled, and it has not been very easy. There are ways, however, that people can increase their occupancy, and I am here with one of them. I am here with Elias Papasavvas. He's the CEO and founder of Elderlife Financial. Elias, your stated goal was basically to bring consumer finance to the seniors housing market with a consumer line of credit to help pay the rent if they either couldn't afford the full rent and have their children sign on. How many communities is your loan product offered in today after a few years?
Today we have 2,700 assisted living and independent living communities offering the senior living line of credit.
Wow. And what do you think that's going to go up to in the next year or two?
We see it headed to 4,000 in the next 18 months.
Oh, that's not bad. And once a company, and more particularly at the local level, the executive director, once they fully understand the product, how to introduce it to the resident, at each community where your loan product exists, how many additional residents each year would you say that by offering a product move into that community?
Execution varies widely. If it's executed well and it's executed correctly in an 80-bed community where 40 units turn over, or with available occupancy plus turnover, you have 40 units out of the 80 in a 12-month time period, you can see 3 to 4 units finance to move in if it is a routine standard part of the presentation process to a family.
And I mean, 3 to 4, when people are losing 200 to 400 basis points of occupancy, that to me that basically saps that right back up, and to me that seemed to be a no-brainer. And what kind of dollar volume have you done to date, and what, with your structure, what dollar volume is Elderlife capable of doing going out in the future?
To date, we have taken roughly 20 million in applications in the 48 contiguous states for the senior living line of credit. We could take it up to 100 million plus through our relationships with a variety of banks around the country.
Okay, and you've been recently, the big issue today is the housing market, and seniors can't sell their house. So they won't move anywhere. You've been piloting a home equity line of credit, or a HELOC product, for potential CCRC residents who can't sell their home because of current prices or whatever reason. How's that pilot going?
That has surpassed even our wildest expectation and our imagination. In 8 months of providing the product to under 20 CCRCs in a pilot capacity to test it out and feel it out, we have taken $48 million in applications with a 98% approval rate.
So in 8 months, that's more than double what all the assisted living was. I mean, no wonder that surpassed it. I mean, I know they're bigger loans because it's the equity of the house, but that's got to be huge.
It is. The average CCRC loan is 300 to 400,000, and the average assisted living, independent living line of credit is 23,000. So it's easy to get to tens of millions when you're doing them 300,000 at a time.
Well, and the assisted living one's more of a longer term, and the home equity line of credit's more of a short term until the house is sold.
That's correct.
And is there, in doing this in this pilot program, what have you learned about these potential residents, CCRC residents, their particular homes and their decisions to move into the CCRC? What's been something that kind of surprised you, if anything?
3 things, and they have been really new to us and the CCRCs that were participating in the pilot. We've learned that seniors, whether single or as a couple, that are moving into CCRCs have 3 primary concerns. So whether they may not necessarily be meeting the need-based definition that the industry has, but in their mind, psychologically, they feel they have a need. And the first reason is they're planners by nature. They want to take advantage of putting all the plans in place, especially if it's a couple. The husband wants arrangements taken care of as they're moving into the CCRC, because if he doesn't live as long as the spouse, he doesn't want his wife having to worry about things. That is number one. Number two, in the case of singles, whether it's a widower or a widow, the isolation of living in a house by yourself, the kids have left, they're no longer nearby, you're really living alone. We are seeing high net worth seniors that are eager to move into a CCRC because of the socialization that a CCRC can provide.
Even if they can't sell their home?
Even if they can't sell their home. And there is real sadness if they can't do it. Real sadness, real frustration. They have the assets, they have the net worth. It's just an inability to liquidate at a decent price point. Even if they're going to lose money, they're willing to sell a house at prices much lower than 2 years ago to make the move. And the third component is locking in the life care or continuing care component. Especially in the situation of couples, one of the two may not qualify for the life care component if you wait 3 years or 2 years.
Or 6 months.
Or 6 months. And so if you can provide them with liquidity to make the move when they want to make it, you'll get the move in, they'll get the lifestyle, and both parties benefit. So it's not the industry need-based definition as we look at it in assisted living, but it is a personal psychological need within their minds and a desire to make the move.
Well, it sounds like with the pilot being that successful, some of these CCRC operators, and especially the new CCRCs opening up, better start taking a look at your product, and hopefully you can expand it to them, because there's obviously a need out there.
We're very excited about the potential because it really is a win-win for everybody.
Okay, good. Very good. Thank you very much, and good luck in 2010. Hope the loan program keeps on going.
Thank you, Steve.